We're witnessing a massive sell-off in the markets, and of course the big news development that has spiraled, and spooked everybody on the street is Russian attack on Ukraine. And to help me understand what exactly is happening on the markets, how are things likely to play out, I have Aashish Somaiyaa, the CEO of WhiteOak Capital, joining me today. Aashish, thank you so much for taking time out. An absolute panic, whether you call it correction or a panic attack, what we're witnessing right now is massive amounts of selling across the board, across all the key global markets. What is your assessment of it? Will it only get worsen, or will it only get worse from here, or could things stabilize? Now that the worst is over, the worst that everybody was waiting for has already happened.
Yeah, so, Karunya, thanks for having me. But what I would put it this way is that, few days back, when first time this became like an imminent threat that there will be a conflict, we saw some, 3% decline in Nifty. And then there was some pronouncements to the contrary. And then we had a 3% recovery. And then now again, today we are 2 to 3% down on the Nifty, depending on when you look at. Plus, of course, slightly more damage as far as small and mid caps are concerned. But to be honest, I wouldn't call, these 3-4% movements. Frankly, I wouldn't call them really mayhem or panic. Yes, if you look at stock-specific movements, people who are investing in individual stocks, people who are trading, definitely they would get a lot more impacted. But if I broadly speaking talk on behalf of the average, mutual fund investor or the segment that we guys deal with or cater to, I really haven't seen any panic from our investors. And, even if you look at it, given where we have come from, given the kind of economic improvements we've seen in India, given the kind of corporate performance results that we are seeing, I think 2-3% is something which is easily digestible. I'm not saying it cannot get worse, but I think that the way the market is reacting or the way investors are reacting, I would definitely say that there is concern out there. Oil prices and stuff that has bothered us in the past. There is concern, but I would refrain from terming it real panic or mayhem really.
But see, what we're witnessing right now is not really a surprise, right? In any war-like situation or any geopolitical crisis of this kind will sort of trigger this kind of a reaction from the markets. So what should investors do right now? You're saying there's no need to panic, at least as of now. But the way gold is, running up, the way oil prices have really zoomed up, do you think people should exit right now, or should they just patiently wait by to see how this plays out?
Yeah, look, I think the people who are invested, I think the answer is always difficult to answer for people who are already invested. A lot of times discussion happens, on buy the dip kind of stuff. Yeah. I think you are absolutely right in asking, leave that aside for the moment. The question is for the people who are already invested out there. I don't think that there is much virtue in really selling right now and then trying to buy later.
Yeah.
Because, by the time you have sold, depending on what stock or what index or what mutual fund you're talking about, by the time you're looking to sell, you are maybe 5-10% down, correct? By the time you actually sell, maybe you are another 2-3% down. So there's no way to you obviously not caught the peak. That's out of the question. So that's one. Second is that when it comes to entry, it's not like you're going to absolutely catch the bottom. So that also doesn't look like a realistic possibility. So for people who are already invested, I think the best option is to remain invested. Also, let's keep in mind, we have to think that other than oil prices and other than long-term politics, how is this directly going to impact India at this point in time? I think we have to think about that, and it doesn't look like much. Even as far as oil prices are concerned, all the data that we see, whether it is our external situation, external macros, whether it is forex balances, whether it is our ability to tolerate oil prices, is much better than what it used to be 10 years back, because a lot of the external trade dynamics have changed out there. So you can clearly see that this time around at $100, we are not reacting as badly as we would have reacted, say, in 2009 or 10.
Yeah.
So that has also changed.
That's true. But, the slogan of buy the dip has been doing the rounds for many weeks now, ever since the volatility phase started. So what would you like to say to people at this juncture, the ones who were promoting buy the dip, philosophy, or are still looking perhaps at the current juncture as an opportunity to buy?
No, I think, look, some of these slogans or mantras are probably addressing or relevant for people who are on the fence, right? And there is always a new bunch of guys on the fence for whom it might be relevant. But if you talk about, say, you and me who have been investing in markets all along, I don't think I have money to keep on buying each and every dip, really speaking. Second is that to the extent that buy the dip might suggest that because today market is 2-3% down, why don't you invest today? I think that also would be premature. We should not panic sell. We should definitely not panic buy. So I would just say that it doesn't look like it is going to impact our corporates or our markets or our economy immediately in a very sharp fashion. But all said and done, look, in the last 3 to 4 months, we have been doing better and better. But all said and done, because there is a global risk off, previously because of US and now because of Russia. So globally, there seems to be some kind of risk off as far as equities are concerned, and there is a downdraft in the markets. So better to kind of just sit it out and not really jump in immediately. There's no harm in watching it for the next 7 days and then deciding a future course of action. So on a day like today, I would just it doesn't sound nice, but I would just say do nothing.
Okay, well, inaction is, the mantra then, it seems, for today. But, if we specifically look at Dalal Street, today is also the expiry. So, given how, things typically play out, do you see any kind of, reversal in trend because of the internal expiry event?
Yeah, I mean, it could happen that, towards the end of the day, people would not want to stick their neck out on any direction. So given how the trend has been in the last few days, weeks and months, you might actually see that, market doesn't do as badly. And by the time we end the session, it may not do as badly as it has been doing since morning.
Okay. We're getting a lot of live, observations and queries as well from our viewers who are watching the show right now. One of our viewers wants to know what should be the investment strategy. Is it SIP? Is that the right way to go right now, or should one buy in lump sum?
No, see, that is always the right way to do it. I have always, if somebody has money which is lump sum, we have still been telling people that put money in the liquid fund and then, slowly over the next 6 months. I just, in a very dumb fashion, I always tell people that, spread it over 2 result seasons and spread it over what is happening in the US and the Western world. So maybe over the next 4 to 6 months is how one should really stagger it. So SIP or systematic transfer or, slowly dripping in your money is absolutely always the right strategy. The only time in my entire career I've told people not to sip, but to start, gulp is actually only in March 2020 when, it became like quite crazy. But other than that, it's always best to spread it over the next, say, 6 months.
If we look at, the various assets, oil prices zoomed, to back, to 2014 levels when it was, at beyond $100 a barrel. Gold prices have shot up, and that typically does happen during any kind of, crisis and tension periods. But what do investors have, in terms of learnings from this? Because, especially those who've been betting big on digital assets, because cryptos right now are witnessing a sell-off while gold has spiked. So, should one stay, with old school norm, old is gold? Should they, is that the big learning here? Or should still they, look at other crypto assets and other newer assets that are coming into play?
Yeah, so while I have always been associated with the stock market for very many years, but personally, if you ask me, from a personal finance perspective, from an investor's perspective, I'm quite a believer in this category, which is called multi-asset funds. We ourselves don't manage any, so no vested interest. But in the past, I have been involved with creating these multi-asset funds. Look, because it is futile we can't forecast a war. We can't forecast oil prices. So it is futile to think that I'll be in the right place at the right time. You can never catch the asset class at the right moment. It's just not going to happen. Even as we speak, some people must be thinking that, oh, should I buy gold? Or should I not have had gold in my portfolio? Or what did I miss? That must be the sentiment right now. So the point is that you should always be in each of the asset classes. So let's say if you have a portfolio which is 100 rupees, correct? And if you're somebody who's targeting, say, 8 to 10%, example, conservative investor, then it's always better that you have a portfolio which is, say, 20-30% in equity, say 10% in gold, say 10-20% international equity, and say 40 to 50% in domestic fixed income. Now, if you create such a portfolio, what will happen is that you are partly in equity, you are in international equity, you are in gold, and you are in fixed income. And all of these are not perfect correlation. They are not +1 correlation or -1 correlation.
Yeah.
Exactly when equities do badly is when gold seems to, it's not like gold is going to give like massive return in such an asset allocated portfolio, not like gold is going to give a massive return. But on a day like this, it's clearly a dampener for the volatility, right? It cuts the downside.
Right.
So the best is to, consult any good advisor or planner and get a proper, I gave an example of something which can get 8-9% return, but you can similarly construct something which can get, say, 12 to 15% return, of course, with a higher volatility, because your risk expectation you have put there is higher. So it's always better to be in all asset classes and to be in an asset allocated portfolio, because, like Charlie Munger said, if you tell me where I'm going to die, I'm never going to go there. That's a sarcasm to say you can never be in the right place at the right time. It's not possible.
Right. But is it too late for those who've missed the bus on gold? Is it too late to invest? Should they wait for some, cool off to happen there and then invest, or can they still enter at the current level?
Yeah, no. So just in the previous one, like I was saying about creating an asset allocated portfolio, the point is that there's no right time to do it. If you realize it today, do it today, because asset allocation is just like chemistry. When you mix multiple substances or multiple compounds, you create a new thing, and you don't expect the new thing to consistently hold the properties of what you mixed into it. So once you make an asset allocated portfolio, you don't need to then worry whether from that point gold is going to go up or down, because now, in your question is embedded the obvious inference that if gold goes down, equities will recover.
So given the, chemical compounding and chemical experimentation involved, trial and error, what is the formula for a perfect portfolio according to you? What kind of exposure should one have to different asset classes? Ideally.
So that's what so, it should be made based on what are you targeting. If you're targeting 8-9%, then there is a different mix for it. If you're targeting, say, 12%, 15%, there's a different mix for it. And if you're targeting just capital protection, like 5-6%, but capital protected, then there is a different mix for it. So I think you can create all these combinations, and it's better to be in a combined portfolio rather than to have only equity, only gold, because you can't individually manage this. The long-term solution is always have a combination of all, know what return you're targeting, and ensure that all those assets are not like perfectly correlated. They should be uncorrelated so they can control your risk.
Before we let you go, just one quick word of advice for new investors, because the ones who entered the market in the last, 1.5, 2 years, they've only seen the markets go up. For them, it was this amazing place where everything was looking up and, there was absolutely or almost no amount of volatility. But over the last few months, they're witnessing something that was completely unprecedented, especially now, a global event of this stature. So what is your advice to them? How should they, prepare themselves better for it, and what should be their strategy?
See, I've written it in some places, and I always said that, the first time, because if you look at investors as cohorts of investors as they enter the market, as you will recall, Karunya, a lot of new investors, this whole bump up in demat accounts and mutual fund SIPs is not just post-COVID. The first time we saw a real move was post-demonetization, when we all had to engage digitally and, cashless, and, tech really took off. So there is a big cohort of people who entered in 2017-18. Now, if you see from their lens, the stock market is a very difficult place to be in, because a lot of people entered in 2017-18 and 19-20 was a disaster. So there is definitely a cohort of people out there who thinks that stock market investing is like gambling and it's very difficult. And then the other cohort is what you refer to, which is people who came in 2020-21 who think like, what is all this song and dance about? It's so easy. I mean, what is it? Why can't people just seem to get it? Right? So for them, it's a learning today. So I think the 2017-18 cohort will be, now in some sense happy that, okay, look, this is how it works. For them, it's a different learning. But for people who came in 2021, so maybe I give a long explanation, but it's not as difficult as it appears to the 2017-18 guys, but it was never meant to be as easy as it appeared to the 2021 guys. So I think this is now a leveler. I think everybody eventually gets an average return, which is linked with how the stock market and corporate performance in general should do. And all the headwinds and tailwinds and overvaluation or undervaluation should get kind of evened out. So it's just a natural process of the market of onboarding, and streamlining experiences.
So bottom line being no pain, no gain, right?
Absolutely, absolutely. It's never as easy as it seems. It's never as difficult as it seems.
Okay, well, let's see how this painful phase plays out. It seems to be just the beginning of, the attack that Russia has, done on Ukraine. Let's see how this plays out and how the markets, most importantly, digest it. Mr. Somaiyaa, thank you once again for taking time out and for, sharing your learnings, your insights and your reading of the market with us. Thank you once again for joining us, and thanks to all our viewers of Money Control for tuning in.